market fluctuations, global trade, all those things are uncertainty, and uncertainty equates to risk. And the things that we can do is protect what we have out there using risk management like subsidized crop insurance. Do what you can to protect what you have out there, right?
Welcome to Compeer's Ag Edge, brought to you by Compeer Financial. In each episode, we break down complex agricultural economics, policy dynamics, and farm business topics into conversations that make sense for your operation. We're here to help you stay informed and confident about the trends and decisions affecting your agricultural business.
All right, good morning, everybody. Compeer folks, Compeer clients, welcome. We're here today to give you a crop insurance update that is so timely with the spring. We are going to cover on the crop insurance side and ag outlook. We're going to talk about the One Big Beautiful Bill as the acronym that I've heard around. I kind of like it. It's OB3A. Sounds like some Star Wars C-3PO kind of thing. And we're going to finish off with price action and what that's going to give you for revenue coverages and some products that you can look forward to. From a broad perspective, we just had the USDA Outlook Forum, I think last week, and they revised some forecasts for corn and beans. So they're thinking corn acres are going to be down from about 98 million, almost 99 million down to 94, and subsequently bean acres going up from 81 million to 85. Part of that is due to the supply, the stock-to-use ratio. It comes down to a supply-demand equation. A lot of people look to the ratio of corn to bean prices. And where that sweet spot is about 2.45 is where that starts to favor soybeans. As we sit today, we are hovering around that 2.4 range. So I do think a lot of that combined with the possibility for China buying some soybeans, maybe some upward price lifts with SAF and biofuel markets. I think that could create some demand to lift, honestly, both corn and beans. But as it sits today with just raw price action, as we look at the December futures for corn and the November futures for beans, that ratio is starting to get on that line to start favoring beans. And I think that's why we're going to start seeing that shift. It's not a dramatic shift, but it is a noticeable shift, from about 5 million acres trading off between corn acres and bean acres. And moving on here, going back to the balance sheet, we're looking at the cost of production. And the corn production is not going down. Labor costs are not going down. We've seen some decreases since the highs of that 2022, 2023 era. But just because your chemical, your fertilizer, your seed might be going down, your other costs may not be going down, such as land costs, cash rents, labor, machinery, things like that. So cost of production is still high, still squeezing some of those margins. And as we look at the net income, farm economic stress, it continues into 2026. It's distinctively showing you net cash farm income with and without federal support under 2026 brought us right back to that 2025 level, but you can see 44 billion of that was due to economic relief and disaster relief assistance from the federal government, namely ECAP, SDRP, and what we're about to see in the FBA, Farmer Bridge Assistance Loan. So the government has stepped in and given out a lot of assistance payment to try to help those tightening margins to help continue strength in the farming sector. Farmer Bridge Assistance, so that's the newest revelation. So we are seeing about $11 billion to come out of that. You can get on farmers.gov, fill out an online application. You got to have a 2025 acreage report on file and an existing login. If you don't have a login, you can create one. Starts paying for online applicants first. So priority there will pay in your favor. So I would recommend everybody out there, clients, go online first. Compeer folks advise clients, prospects, get online first, because that's where the priority is going to be. That enrollment period is going to be 2/23. So that would be Monday, and that's going to run through the 17th of April. Payments are said to be starting 2/28. So we could see the earliest payments coming out then. So keep an eye on your accounts, get those logins set up, get your information in at the FSA. And as always, if you have questions with these programs, please reach out to your IO, your FO. While we don't work for the FSA, we can try to help the best that we can. With that farmer bridge assistance, it is not without notice that the sentiment in the market still believes that it's really still not making us whole. We're still experiencing some net losses across a myriad of crops, but particularly in rice, cotton, oats, peanuts. And nonetheless, I think the overall net income of farmers, even with the disaster income this year, was not as positive as everybody hoped, even with the bumper yields, and which plays into the global trade scenarios of today's world that we have going on, and some very drastic needs for some improvements in the infrastructure and the throughput for things that are coming out of 45Z, the GREET model, SAF, sustainable aviation fuel, biofuels, things like that, which I think that infrastructure is being built. It's underway. So we're pretty optimistic that that's going to start carrying some momentum here over the next year, 2, 3, 4, 5 years. So, and of course, as I mentioned in the beginning, it's not a crop webinar in 2025, 26 without talking about the one big, beautiful bill. So I wanted to put this second because first I wanted to give us an outlook on kind of the planting scenario, the supply demand side, talked about the margins, talked about the income. So there's some saving grace, some light at the end of the tunnel through this one big, beautiful bill that raised subsidies across the board. So simply put, the cost of raising crops is one of the highest, if not the highest it's ever been. But the good news is that protecting those crops that you grow is going to be the cheapest that it's been in a long time. It's going to be significantly cheaper than it was last year. Brandon's going to get into that a little bit later as we're going to show you. But some of the main highlights here that I want to cast in front of you is the supplemental products. These are things that sit on top of your individual base coverage. They are area plans, but they are highly, highly subsidized with tremendous amount of premium support, as we're calling it now, 80%. So that's up from 65% last year. And although that may sound like, oh, it's just 15% additional, well, if we translate that to your pocket, those products are actually about 43% cheaper in the end. And again, Brandon is going to show you some of those things at the end. So really take a hard look, if you haven't already, at the supplemental products, namely ECO, SCO. Those are going to be big drivers in the market in getting shallow loss coverage for producers out there. Moreover, your general unit structure crop subsidies also increased about 3% across the board for every coverage level and every unit election that you could make. So premium savings across the board for producers out there, which is going to be significant this year for farmers. Additional changes with beginning farmer ranchers. So that provision traditionally ran 5 years. They've now doubled that to 10 years if you qualify, right? So they also threw in a sliding scale of premium subsidies starting out in your first 2 years, an additional 15% on top of whatever subsidies already exist out there. And then that trails down from 13 to 11. And then in years 5 through 10, you're going to land at that standard 10% that we've seen for a long time. So big benefits for new beginning farmer ranchers, those of you that qualify. Last but not least, in terms of the major crop insurance ag-related impacts here are to Title I. Title I, another name for Title I, that is your ARC and PLC payments. That's your agricultural risk coverage and your price loss coverage. Those got bumps. So we saw reference prices increase across the board. ARC now goes up to 90% versus 86 where it was before. And because ARC went up to 90% in its coverage and a 12% payment cap, it no longer mirrors SCO's coverage. So now you don't have to pick between taking ARC at the FSA and SCO with your federal crop insurance. You can actually take both now. But for 2025, the decision had already been made, but they implemented a change there that you're automatically going to get paid the higher of which one of those are going to pay. And right now, I think a lot of crops are probably sitting in the money, more in the money on PLC, but we're going to see how that shakes out. Last part with Title I is 30 million additional base acres are going to be added to that program, which is a huge lift. And in Illinois particularly, I think we're going to see a lot because 98% of those non-covered commodities in the past, it's a large number. So Illinois is going to heavily benefit from that. Wisconsin and Minnesota in our footprint also going to heavily benefit from that as well. So ARC, I mentioned that the reference prices were increased. The coverages were increased. Okay, so the statutory reference prices were for corn and beans $4.10 and $10. A lot of money went into that program to lift those up to $4.42 and $10.71. So as it sits today with the marketing year average for that 26 time frame, $4.10 and $10.30, we're already sitting in the money on PLC. Now again, we have about 5-6 months left in that marketing year window to see how that plays out. And then we also have to see how those final yields come in for ARC. So a lot to be determined, but nonetheless, for 25 anyway, you guys are going to get the higher of the two payments. All right, moving on to risk management. Brandon, walk us through what our producers out there should keep their eyes on and to lock in coverages, things to look at, an approach to risk management as a whole, as we have about 15, 16 days left before March 15th sales closing.
Yeah, thanks, Cole. Now that we have the weather and outlook, along with the great changes that came out of the OB3A, let's take a look and see how those benefits can help your operation on the risk management side for 2026. I know I'm excited about all the changes and the positive we have for crop insurance for 2026. I know many of you might think, "Oh, crop insurance, something we need to have," but I think this year it's exciting. We got some great opportunities out there, and let's dive deeper into what our options are. First, I want to start with the FSA programs that are available. As Cole mentioned, the ARC and PLC, those have no premium costs, but they differ quite largely from crop insurance in many ways. A couple of those differences I want to point out: ARC and PLC, that pays on base acres, not planted acres like our multi-peril crop insurance program. ARC and PLC also pays the following October after that crop year is over. Versus your individual base policy will pay after completion of harvest, or those stack coverages such as ECO and SCO that I'll go through here a little later, pays the following June after the harvest year. So there's different times that if the payment trigger, that those will be released. Another big key difference is ARC and PLC uses the market year average for pricing. So that starts on September 1 of that crop year until August 31st of the following crop year, instead of our base policies and those stack coverages use a spring and fall price for that current year. So that's February and October time frame. So another couple things: ARC has that 12% payment cap. PLC, price loss coverage, has no cap. Other side of things, on your base policy, it protects from the level you chose down to 0. So there is a lot of the differences between Title I and our base policy with stack coverages. So I want to talk a little bit about 2025. I know Cole covered, we're going to receive the higher of the two. So that's a great benefit for the producers, since the OB3A made some changes after we made our decision for 2025. With the increased reference prices, the programs are much more effective than they have been in most recent years. Also, as you know, our county uses the Olympic average yields and price to determine a county revenue. And most likely in most of our listening area here, we've experienced some pretty decent production in the last few years. So likely those Olympic average yields have increased, which gives you more coverage on the ARC County side, as well as these higher prices that Cole mentioned previously. FarmDoc has estimates out there for 2025 for ARC and PLC payments. Currently, we're only sitting around halfway through the marketing year average for 2025. So things can change. But based on today's prices, we're currently sitting at, this was released back in February 10th, at $4.10 for a marketing year average on corn and $10.20 for a marketing year average on soybeans, which are below our price floor currently, which Cole was saying that, as of right now, PLC looks to be like it's going to be paying for 2025 because our price floor on corn is $4.42 and $10.71 on soybeans. So that $4.10, $10.20 are much below that currently, but we're only halfway through our marketing year average for 2025. So there is some time to go on yet. We'll see what prices do, but right now that's the estimates that are out there from FarmDoc. And ARC or PLC triggers a payment for 2025. Those will be distributed this coming October, so October of 2026. Moving on to 2026, as Cole mentioned previously, they are adding 30 million base acres to the program, and that will need to be implemented prior to sign up for the 2026 ARC and PLC. So at this time, there hasn't been a date set up for sign up for 2026 ARC or PLC. Many sources out there that we have seen expect it to be delayed, and maybe as far as after harvest of the 2026 crop. But like I said, we don't have confirmation from FSA on this, but that's just what other sources are telling us. Being delayed, some might think, oh, we want to make this decision, but it's a huge benefit to the producer making this decision, because as time goes on, we'll have more insight on price and yield the longer this is delayed. So, if it's after harvest, likely we can kind of know which program will be the better fit, since we won't be getting the higher of the two like in 2025. One less decision we need to make before March 15th, so we can focus on our crop insurance decision now, and that's kind of what I'm going to roll into next is our 2026 decisions. And when making your choices for 2026, there's a lot of things that come into play. You must know what risk you have out there, such as knowing your cost of production. As Cole mentioned earlier, the cost of production and prices might cause a shift in corn and soybean acres, and being prepared for those marketing opportunities when they're existing because of acre shifts. Crop insurance is a great tool for that. Prices historically have moved significantly over a period of time, and utilizing your crop insurance guaranteed bushel to take advantage of those marketing opportunities, knowing you have the protection on those bushels. Once you know what your risk is out there, how we can best cover that for a reasonable cost. We always want to start with a solid base policy and then look at the endorsements to fit to reach my target coverage, such as SCO and ECO. For some, other factors play a role as well, such as hail and wind insurance, but this typically will be area specific based upon previous experience. Look at Northern Illinois, that's in the derecho corridor. So wind is likely another concerned risk for the producers in the Northern Illinois area, and maybe shifting up into Wisconsin and Minnesota. But everyone has a different tolerance, and what fits them might be different from one area to another. But there's a lot of things we need to look at. But keep in mind, multi-fill crop insurance is typically a producer's lowest cost input and is likely to be under 3% of total cost per acre. So it's very low on the cost standpoint when you put everything as a whole, when you're looking at corn or soybeans. Now shifting to kind of a little bit of price history the past few years. In most of our LSA, we have seen probably average to above average yields. And typically the price is the main driver for fluctuations in our gross income per acre. The revenue component of the base policy or these endorsements in crop insurance does a great job for protecting that price movement. Show a price decline from that spring price to the fall price. And the ones in the green show where years have prices that went up from spring to fall. So you can see there's some high percentage years that either prices went significantly higher or significantly lower. So kind of the main driver of that revenue portion of your policy. The variance from RMA, crop insurance prices, harvest price versus that marketing year average that is used for ARC and PLC. So some could argue that, there's some years that there's a big difference between the price from ARC and PLC versus that RMA or the crop insurance price. So because they're in different time frames, et cetera. So like I said, there's a little bit different there from that standpoint. As we shift to how we are sitting today, shows we are currently tracking for our corn and soybean prices for 2026. The spring price and the producer's APH is used to determine a producer's revenue guarantee. Corn is currently sitting around $4.60 and beans at $11.05. Been going up, so every day our average on soybeans has went up at least a penny, causing the soybeans to raise about 20 cents from where we started in early February on price. And as Cole mentioned, we're seeing that ratio, corn to soybean, that ratio pointing more to bean acres for 2026. The other thing to take note is the volatility, and that's measured the last 5 trading days in February. And we're sitting currently a few points lower on volatility than we've had in the most recent years. The volatility is the measurement of the movement in the market, and a higher volatility causes those premiums to be higher. So where we're currently seeing with volatility being lower this year, and if it remains low these last 5 trading days of the month of February, that will be another factor that will cause lower premiums for 2026. On top of what Cole already mentioned, premium support, as well as some other factors that will play a role we'll talk about here in a little bit. I put ECO trigger, an SCO trigger, and an RP trigger. That coverage percentage played a big role in establishing a good coverage for 2026. And we'll go more into depth on ECO and SCO. RP, your revenue protection, your base policy, by itself might not provide the amount of price protection that is needed as we sit today. Show Farm Doc's break-even prices for Northern Illinois, and when including land costs, this is sitting right around $4.50 per bushel for corn and $10.93 for soybeans. That percentage of change from that projected first harvest price in corn. But what I want to point out here is, that where the 86% and the 95% trigger points are. So you can see with those SCO and ECO products, we went well above, that 5% deductible on ECO, how many times we have went well below that and would have triggered a loan just with an average county yield. So like I said, we're going to get more into the ECO, SCO here in the next, which is showing kind of how much deviation from that 0 point percentage we have went in either direction, higher or lower. A lot of times we have triggered a 72% of the time in corn, we would have triggered an ECO indemnity if we had an average county yield or below an average county yield. So let's go start with what is, adequate coverage. I'm using U of I crop budget for Northern Illinois for my example. As we all know, everyone's cost of production will differ, but likely be comparable to last year, if not, slightly up from last year. This example here shows $789 on corn for total cost before land. So I just threw in adding, I think, a very conservative $250 per acre land cost. With that, it puts us over $1,000 of cost per acre of corn. So we're going to use that kind of as our building our policy out for 2026 and these examples going forward. So now we're going to pretty common coverage level of 80% individual coverage. Over the past few years, a producer keeping that same coverage level they've had in place is probably likely not enough. You go back to 2023 when prices were near $6 a bushel, 80% policy would more than cover our cost of production. But that isn't the case in the low price environment we are in today. For this example, I did use a 225 APH. So this can vary based upon what your producer's APH is, but this gave a kind of a rough average to estimate the liability for the policy. Costs are pushing over $1,000 per acre, and my typical 80% RP base policy most likely wasn't giving me enough coverage that I need for 26. So what other options do I have? One option could be going to 85%, base policy individual. That would add you another $50 of coverage, but likely still not enough to provide the coverage you need to cover costs. The good news is we have those endorsements such as like ECO and SCO that can be utilized to help get closer to covering risk. And as Cole mentioned, with all the premium support changes and volatility being down, we can likely add more coverage without increasing costs, much if any at all. The supplemental coverage endorsement provides a band of coverage from your underlying policy up to 86%. So in this scenario that I have here is 80% on the individual coverage, so that SCO coverage will go from 80 to 86%. And then from there, we can add on ECO coverage, enhanced coverage option, that'll go from 86 up to 90 or 95%, depending on what you choose. You can take it just a 90% ECO or a 95%. If you take that 95, you're only leaving a 5% deductible at the top. So, $50 deductible roughly in this example. Both of these products, SCO and ECO, have the 80% premium support. So the producer's only paying 20% of the actual cost, premium cost. SCO and ECO, big thing to point out here is they trigger based upon county revenue. But the liability, the coverage is established based upon the producer's APH. So the higher APH you would have, the higher liability established for those ECO and SCO. But since ECO and SCO use county yields, those endorsements do not pay until the following June when yields are released from the RMA. So, unlike your base policy, that'll pay upon Bradford harvest, the SCO and ECO staff coverage is on top of your base. will not be paid until the following June. Based on recent agricultural economic projections for the 2026 interest in ECO, as we talked about there before, ECO might be an option that we can add on top of our base policy to help cover the cost that we most likely will incur for, planting the corn or soybean crop. They expect the ECO participation to increase substantially to 179 million acres nationally. This would be tripling the participation from 2025. The why behind this forecast is that this product provides more coverage in an environment of low prices, high production costs, negative net farmer return. For the normal coverage you've been taking in the past few years won't meet those levels. Look at ECO from a price perspective. It only needs to fall 5% before it triggers a potential indemnity with average county yields. This provides great protection with those price drops we've had over the last 26 years. I put a question mark in for the SCO box because the past few years, many producers were taking the ARC Title I program so that we had a conflict with SCO. So you couldn't have ARC and SCO. So nobody took SCO because, like I said, they elected ARC at the FSA office. But as Cole mentions, with the one big beautiful bill, there's no longer a conflict. So I would expect to see a larger increase in the participation in this endorsement as well as ECO. So yes, we do see ECO to maybe triple participation for 2026, but I likely to see SCO gain a lot of traction as well with not having that ARC conflict that we have had in past years. Now that we've gotten through all this, let's look at some premium costs and for 2026. So starting with, when comparing input costs from 25 to 26, like Cole mentioned, our crop insurance premiums are down significantly. And most likely probably the only thing that's down for 2026. Here, I compare 2025 premium versus 2026 premium with a producer taking an 85% base policy RP with the ECO enhanced coverage endorsement that we discussed. Both years have named nearly the same result of just shy of $1,000 of coverage. But look at the premium difference, almost a 40% reduction in premium for the same coverage you had in 2025. This year, and now that we have saw how those changes, affected our 2026 premium costs, let's move to kind of where 2026, options we could possibly have. We see that we've seen a reduction in premium costs, in this example, almost 40%. What are my options? And they can loan be hundreds of dollars below break-even costs. And simply increasing coverage to 85%, as I explained before, might not get you to that red line, as U of I Farm Doc has $1,000 of break-even costs for corn in Northern Illinois. That's leaving roughly $200 not covered. And then you think about that when you multiply that over your acres that are farmed, $200 an acre times those acres tends to be a pretty large number. So I encourage you to utilize the heavily subsidized endorsements such as ECO and SCO that allow you to get closer to that break even, that red line, without breaking the bank on the way. On the bottom is the premium for the plans I'm comparing in the graph. As you put more coverage in the green shaded area based coverage, not the individual, the premium cost will decrease because of the high premium support that we have for ECO and SCO. But that is based, as I said before, on an area yield, the county yield, not your individual. So first we need to focus on establishing a individual base coverage that is essential for your operation. And most important, the addition of ECO and SCO will help reach those break evens. We are trying to help ensure that maybe the base won't quite get you there. To close out my portion before Cole wraps up, I encourage you to take time to understand what your crop insurance is providing for the minimal costs and utilize the coverage you have in place to take advantage of marketing opportunities that allows you to be profitable for 2026, knowing that you have coverage on those bushels. And I'll turn it back to Cole for a wrap up.
All right, wonderful. All right, and as always, thank you, Brandon, walking us through real practical situations that we're going to be facing here in 2026. As it comes down to the wire here, what we can boil it down to is market fluctuations, global trade, all those things are uncertainty, and uncertainty equates to risk. And the things that we can do is protect what we have out there using risk management like subsidized crop insurance, get that shallow loss coverage. If you're in a high hail risk area, layer in your hail. Just do what you can to protect what you have out there, right? And secondly, we need to focus on profitability. Maximize those profits, not necessarily the yield. Find your sweet spots in your inputs. Utilize the crop insurance. Evaluate your cost strategies and lock in your break-evens, or as near as you can, lock in your guarantees. So that way you can go to the market with an aggressive grain marketing strategy and keep track of every bushel that gets sold so you know how the balance sheet fluctuates throughout the year. And with that, those are the keys to success here. Main takeaways are that the cost of growing the crops aren't going down, but the cost to protect those crops are going down, and the subsidies are out there up for the grabs. And we want you guys to have sound risk management plans to protect your farms and continue the legacies out there, because your success is our success. So with all the information that we threw at you today, please reach out to anyone at Compeer with questions. We can get you answers. We are sprinting toward March 15th sales close to lock in these coverages. ARC PLC decisions will come later down the line, so let's let that sit on the back burner. But right now, let's sit front and center on what crop insurance decisions we're going to make. And we are here to help you make those. So with that, thank you for your time, everybody. Make it a great day, make it a great week, and good luck this planting season.
Thank you for listening to Compeer's Ag Edge. You can follow us on Apple Podcasts, Spotify, or your favorite podcast app. For more agricultural finance insights and resources, visit compeer.com. That's COMPEER.com. Until next time.